You know, over the years, I've seen markets go through every possible cycle, booms, busts, and everything in between. And if there's one thing I've learned, it's that a recession isn't something to fear, it's something to prepare for. Most people panic when they hear the word recession. They start selling everything, moving into cash, or chasing whatever they think is safe. But here's the truth. If you have the right strategy, a recession can be an opportunity, not just a threat. And today, I'm going to share the #1 strategy I've used and continue to use before a recession hits, something you can start implementing right now. Early in my career, I used to fear recessions the way most people do. Headlines screamed about market crashes, and every dip felt personal, like the world was working against me. I would see my portfolio drop and think, this is it. I'm losing everything. Over time, though, I realized that recessions are not just threats, they are opportunities if approached correctly. The difference between panic and profit lies in preparation and mindset. Treating a downturn as inevitable doom guarantees mistakes, but seeing it as a predictable cycle allows you to position yourself advantageously and take actions that most traders and investors aren't willing to take. I learned quickly the opportunities in a recession are often hidden in plain sight. While most people rush to sell everything, flee to cash, or follow the crowd into safe assets, a prepared trader can identify where value is accumulating. Market fear often drives prices below intrinsic value, creating conditions where disciplined entry can generate outsized returns over time. Early on, I underestimated this because I was so focused on avoiding losses that I missed the potential gains. Over time, I shifted my perspective. A recession is not just about survival, it's about positioning yourself to benefit from the inevitable recovery and capitalizing on dislocations that fear creates. The market preparation is key to seeing these opportunities. I don't try to predict the exact start or end of a recession. That's impossible, and trying to do so often leads to mistakes. Instead, I focus on readiness, ensuring my portfolio is structured to withstand volatility, that I have the liquidity to act, and that I'm mentally prepared to make decisions when opportunities arise. Being ready means I'm not reacting emotionally or impulsively when the market starts to turn. Instead, I can assess objectively, identify undervalued assets, and enter positions at the right time. This mindset alone changes the way you experience market downturns from fear and anxiety to calculated, measured action. Another critical aspect of viewing a recession as an opportunity is understanding the behavior of other market participants. Most investors panic, which drives irrational selling and mispricing. I learned to watch these behaviors carefully because every emotional reaction in the market creates the potential for someone else to gain. If you are disciplined, patient, and prepared, you can step in when others are fleeing, buying quality assets at discounts that would not exist in calmer markets. This is not speculation, it's observing probability, assessing value, and acting when the conditions align with your strategy. I also realized that positioning during a recession isn't about going all in on risky trades, it's about measured, calculated moves. Protecting capital is the first priority. If you lose everything, there's no opportunity left to capitalize on. But once protection is ensured, the next step is to identify areas of strength or resilience sector that have historically performed well, or assets that offer favorable risk-reward ratios. Early in my career, I would often overlook this balance, either taking too much risk or being overly conservative. Learning to navigate that balanced protection first, opportunity second, allowed me to act decisively when the timing was right and to participate in moves that others could not. Ultimately, the mindset I bring to a recession is that of a strategist, not a panicked participant. I see patterns, I assess probabilities, and I look for dislocations caused by fear. While most people see chaos, I see opportunity. The key is preparation, structuring portfolios, maintaining liquidity, prioritizing quality, and cultivating patience and discipline. With these elements in place, a recession transforms from a source of fear into a period where smart, prepared decisions can create long-term advantage and compound growth over time. Early in my career, I made the mistake of reacting emotionally to market movements, especially during periods of uncertainty or downturns. I would see headlines screaming about economic contraction, consumer sentiment dropping, or corporate earnings missing expectations, and I felt compelled to act immediately. My first instinct was often to sell everything and move to cash, convinced that the worst was coming. I quickly learned that reacting emotionally rather than strategically is one of the fastest ways to erode both capital and confidence. Markets are inherently volatile, and panic-driven decisions rarely produce favorable outcomes. Over time, I realized that controlling my emotional responses and avoiding knee-jerk reactions is essential, especially before and during a recession. Emotions like fear and greed are amplified when uncertainty rises. Early in my career, I often let fear dictate my actions. A sudden drop in stock prices felt personal, as if the market was out to get me, and I would exit positions prematurely. Those decisions frequently locked in losses that could have been avoided with patience and a disciplined approach. I also observed the opposite, moments of irrational exuberance, where greed would push me to chase assets at inflated prices. Both extremes, panic and overconfidence, are dangerous, and learning to recognize when my emotions were driving decisions was a pivotal lesson in my development as a trader. One way I managed emotional reactions was by focusing on a systematic approach to decision-making. Instead of responding to every headline or market tick, I developed a process that guided me on when to enter, exit, or adjust positions. Early in my career, I thought intuition alone would suffice, but I quickly discovered that relying on gut feelings during periods of market stress often leads to mistakes. A systematic approach provides structure, reduces the influence of emotion, and allows decisions to be based on probabilities and rules rather than impulse. By following a consistent process, I could separate noise from meaningful signals and maintain composure, even when markets were chaotic. Another key lesson is that emotional reactions are contagious in markets. When a majority of traders panic, prices can move dramatically, creating opportunities for those who remain calm. Early in my career, I was part of the panic rather than observing it, and I often missed the chance to take advantage of dislocations caused by fear. Over time, I learned to step back and assess situations objectively, waiting for setups that aligned with my strategy rather than reacting to the herd. This mental shift allowed me to approach downturns with clarity and make calculated decisions that others were too emotionally involved to see. Controlling emotions also means preparing mentally for losses. Even the best trades can go against you, and markets will inevitably present situations where you cannot predict the outcome with certainty. Early on, I would take losses personally, allowing frustration to cloud judgment and affect subsequent trades. By accepting that losses are part of the process, I could detach emotionally, evaluate what went wrong, and adjust my strategy without panic. This mindset not only preserves capital, but also ensures that long-term decision-making remains rational and consistent. Ultimately, avoiding emotional reactions is about creating a mental framework that supports disciplined action. Before a recession or any period of uncertainty, it is critical to maintain calm, follow a structured process, and resist the temptation to act impulsively. Early in my career, I learned the hard way that panic leads to mistakes, and over time, I discovered that emotional control is just as important as any technical or fundamental analysis. By mastering this aspect, you can navigate market volatility with confidence, make strategic decisions rather than reactive ones, and position yourself to take advantage of opportunities that others miss when fear drives. There are actions. One of the most important lessons I learned early in my career is that managing risk is the foundation of surviving and thriving in any market, but it becomes absolutely critical before a recession. I used to think that spotting opportunities or predicting market movements was the key to success. I quickly realized that no matter how confident I was about a trade or an investment, ignoring risk could wipe out months or years of gains in a matter of days. Before a recession, when volatility rises and uncertainty spreads through markets, understanding your exposure and adjusting your portfolio is not just prudent, it's essential. Risk management is the difference between being a participant who survives the storm and one who gets caught in it. Early on, I underestimated how quickly losses could compound if risk wasn't controlled. I might see an asset with strong potential and decide to allocate a large portion of my capital to it, thinking that the upside justified the risk. But when markets turned suddenly, those positions could spiral against me, and the impact on my overall portfolio was devastating. That experience taught me that even a strong thesis or favorable trend is meaningless if your downside isn't protected. The first step in my pre-recession strategy became assessing every position in terms of its risk, not just its potential reward. This mindset shift was pivotal in allowing me to navigate turbulent markets more effectively. Risk management begins with portfolio allocation. Before a recession, I evaluate how concentrated my exposure is in vulnerable sectors or assets. Early in my career, I often held large positions in a single sector because I was confident in my analysis. But I learned that diversification is not just about spreading capital, it's about survival. By adjusting allocations, reducing exposure to high-risk areas, and increasing positions in more resilient assets, could lower the potential impact of a downturn while maintaining the opportunity to participate in profitable moves. Risk management in this context is about being realistic about what the market can do rather than hoping everything goes as planned. Another critical element is setting limits on potential losses. I quickly learned that having clear stop-loss levels, predefined risk per trade, and a disciplined approach to capital allocation protects not only money but also mental clarity. Early in my career, I would sometimes let losses run, hoping the market would turn in my favor, and that approach only magnified the damage. Establishing rules for risk forces discipline, reduces emotional decision-making, and ensures that even when trades go against me, the impact is controlled and doesn't threaten my ability to act on future opportunities. Understanding risk also extends to recognizing broader market exposure. Before a recession, certain sectors or asset classes are more vulnerable than others. Early in my career, I sometimes ignored macroeconomic conditions or overestimated my ability to hedge against systemic risk. I learned to evaluate correlations, economic signals, and the overall health of markets to anticipate areas where risk could escalate. Adjusting my portfolio with this knowledge allowed me to reduce vulnerability, maintain liquidity, and create the capacity to act when high-probability opportunities presented themselves. Ultimately, risk management is not about avoiding losses entirely. It's about controlling them so that you can remain in the game. Before a recession, it's about being prepared for volatility, understanding your exposure, diversifying intelligently, setting clear limits, and aligning every position with a disciplined strategy. Early in my career, ignoring these principles led to unnecessary losses and stress. Over time, I realized that managing risk is not a reactive process but a proactive one. It sets the stage for both survival and opportunity, and it allows you to navigate market downturns with confidence, clarity, and control. One of the most critical lessons I learned over the years is the importance of liquidity, especially before a recession. Early in my career, I didn't fully appreciate how crucial it was to have readily accessible capital. I would often be fully invested, convinced that staying in positions at all times was the way to maximize returns. That approach worked during stable or rising markets, but during downturns or periods of heightened volatility, it left me unable to act when opportunities appeared. I realized quickly that liquidity isn't just about having cash. It's about flexibility, freedom, and the ability to capitalize on the dislocations that fear creates in the market. When markets begin to turn, those with liquidity have a tremendous advantage. I've seen countless examples where traders or investors are forced to sell positions at a loss simply because they need cash to cover other obligations or margin requirements. Early in my career, I sometimes found myself in exactly that situation, and it was a harsh lesson. You can have the best strategy, the perfect analysis, and the most promising opportunities, but if you can't act, your potential advantage disappears. Having liquidity allows you to enter positions when the market presents favorable risk-reward setups, rather than being at the mercy of circumstances outside your control. Liquidity also serves as a form of psychological armor. Markets are unpredictable, and downturns can create stress and fear. Knowing that you have cash available to deploy allows you to act deliberately rather than reacting emotionally. Early in my career, I often felt pressure to act to chase opportunity or defend positions, which led to mistakes and overtrading. Once I began prioritizing liquidity, I noticed a profound difference. I could wait for the setup. That met my criteria, confident that I had the resources to execute without panic or compromise. That mental clarity is just as valuable as the capital itself. Another aspect of liquidity is timing. Opportunities in a recession are often fleeting. Prices can swing dramatically, and the most attractive setups may only exist for a short window. Without liquidity, you may miss the chance to enter at a favorable point or take advantage of temporary mispricing. Early in my career, I underestimated this and sometimes watched from the sidelines while others, with the resources to act, captured value. I learned that maintaining a reserve of deployable capital before a recession ensures that you are ready to act quickly and decisively when the timing is right. Liquidity also allows for strategic flexibility. Markets don't move in straight lines. Unexpected events can create both risks and opportunities. I've seen situations where a trader or investor without liquidity is forced to make reactive, suboptimal decisions, such as selling positions at a loss or missing strategic entry points. By maintaining cash or cash equivalent assets, I could adjust my exposure, hedge when necessary, and pivot my strategy without being constrained by immediate obligations. Liquidity provides optionality. It gives you the power to respond to the market on your own terms. Ultimately, liquidity is more than just having money sitting idle. It's about being prepared, having freedom of action, and creating the conditions to execute your strategy without compromise. Early in my career, I overlooked its importance and paid the price, either missing opportunities or making mistakes out of necessity rather than choice. Over time, I learned that liquidity is a core pillar of pre-recession preparation. It allows you to remain disciplined, act decisively, and seize opportunities when they arise, all while reducing the emotional and practical constraints that can derail even the best-laid plans. I often chased what was popular or what seemed to be the next big trend, believing that high growth or momentum alone would drive success. I quickly discovered that during periods of market stress, the true strength of an asset is revealed. Companies, sectors, or instruments with solid fundamentals tend to weather downturns better than speculative or over-leveraged alternatives. Recognizing and focusing on quality became a cornerstone of my pre-recession strategy because it allowed you to navigate volatility with confidence while maintaining the potential for long-term gains. Understanding what constitutes quality requires careful evaluation. Early in my career, I sometimes relied on surface-level metrics such as performance or hype without delving deeply into the underlying fundamentals. Over time, I realized that the most resilient investments are those with sustainable cash flows, strong balance sheets, and competitive advantages that allow them to operate effectively even under adverse conditions. During a recession, these characteristics matter more than short-term price movements because they increase the likelihood that an asset will recover and continue to grow once the market stabilizes. Prioritizing quality isn't about avoiding risk entirely. It's about making informed decisions that align risk and potential reward in a meaningful way. Another aspect of focusing on quality is evaluating management and corporate strategy. I've observed that companies with disciplined, forward-thinking management teams are more likely to navigate economic downturns successfully. Early in my career, I overlooked this factor, sometimes investing in promising-looking assets without considering the people behind them. Over time, I learned that strong leadership is a critical indicator of resilience. Companies that make prudent decisions, maintain liquidity, and plan for uncertainty are far better positioned to survive a recession and capitalize on recovery opportunities. This consideration extends beyond public markets. It applies to any asset class where human decision-making impacts performance. Focusing on quality also means being selective. In my early years, I often wanted to be involved in every opportunity that seemed potentially profitable. That approach spreads attention and capital thin, which can amplify risk during a downturn. I learned that by concentrating on high-quality assets and reducing exposure to weaker positions, I could maintain a more stable portfolio while still participating in meaningful gains. It's about identifying what truly has long-term value rather than chasing every short-term opportunity that appears attractive. Selectivity allows you to act decisively and with conviction, which is especially important when the market becomes volatile and emotional. Quality also intersects with patience. Assets that are fundamentally strong may experience temporary declines during a recession, and it can be tempting to sell prematurely out of fear. I learned that having confidence in the quality of your holdings allows you to endure short-term volatility without making impulsive decisions. Early in my career, I sometimes sold positions too quickly, missing the subsequent recovery. Focusing on quality provides a foundation for patience because you know that your investment has the underlying strength to withstand market turbulence and eventually generate returns. Ultimately, prioritizing quality before a recession is about more than just picking strong assets. It's about creating a resilient portfolio that can withstand uncertainty, maintaining confidence in your position, and setting yourself up to capitalize on opportunities when fear drives mispricing in the market. Early in my career, ignoring quality led to losses and unnecessary stress. Over time, I realized that focusing on fundamentals, strong leadership, and sustainable business models provides a competitive edge and a measure of security that speculation alone cannot offer. I remember thinking that if I could predict the exact moment a recession would begin, I could exit positions just before the downturn and re-enter at the bottom. I quickly discovered that this kind of precision is unrealistic even for the most experienced traders. Markets are influenced by countless variables: economic data, investor sentiment, global events, and the timing of a recession is never exact. Chasing perfection often leads to hesitation, missed opportunities, and mistakes driven by fear or overconfidence. What matters far more is preparation, positioning, and acting according to a disciplined strategy rather than trying to guess the precise top or bottom. Early in my career, I would sometimes hold off on a trade because I wanted the perfect entry. I thought that waiting a day, an hour, or even a minute could make all the difference. More often than not, that hesitation caused me to miss significant moves. At the same time, I would occasionally jump in prematurely because I thought I had spotted a turning point, only to be caught in volatility or continuation of the trend against me. Over time, I realized that consistently applying a proven process and focusing on risk management produces far better results than trying to predict every market movement. Timing the market is less about exact entries and more about having a framework to act when the probability is favorable. Another aspect of this lesson is understanding that markets often move in ways that defy expectation. Early in my career, I would attempt to forecast market reactions based on economic reports or corporate earnings, assuming that logic alone would dictate the outcome. I quickly learned that markets are driven by both fundamentals and psychology, and investor behavior can amplify movements unpredictably. Perfect timing would require predicting human behavior perfectly, which is impossible. Accepting this reality forced me to shift my focus from trying to predict precise movements to controlling what I could, positioning, risk, liquidity, and adherence to a disciplined strategy. Patience is another key element in avoiding the trap of timing the market. I realized that by focusing on preparation, readiness, I could wait for opportunity that aligned with my criteria rather than chasing each fluctuation. Early in my career, impatience often caused me to enter trades too early or exit too late, motivated by the fear of missing out or the desire to catch the bottom. By committing to a systematic approach, I could wait until the conditions were favorable and the risk-reward ratio made sense. This patience didn't require me to predict the exact moment a recession would hit. It allowed me to act logically when the market presented a high probability opportunity. A related insight is the importance of flexibility. Even with preparation, markets can surprise you. Economic indicators, geopolitical events, or sudden shifts in sentiment can change the landscape rapidly. Early in my career, I would sometimes stick rigidly to my plan, trying to force trades to align with my expectations. I learned that flexibility, combined with disciplined rules, allows you to respond effectively without abandoning your process. It's not about trying to outguess the market, it's about being ready to act when your strategy signals a favorable opportunity. Ultimately, I learned that obsessing over perfect timing is counterproductive. Early in my career, I chased the illusion of precision and paid the price in missed opportunities and unnecessary losses. Over time, I realized that preparation, risk management, liquidity, patience, and discipline, execution matter far more than predicting exact market tops or bottoms. Markets are unpredictable, but a systematic approach allows you to respond effectively, capitalize on opportunities, and protect your capital, no matter. When a recession begins early in my career, I was often so focused on return that I underestimated the importance of preserving what I already had. I would chase opportunities, take on excessive risk, or hold positions too long, believing that the upside justified the exposure. Over time, I realized that no matter how promising a trade looks, if your capital isn't protected, all other advantages can evaporate in an instant. Protecting what you have is the foundation that allows you to survive downturns, recover from mistakes, and participate in opportunities that the market presents, especially during recessions. Early in my career, I learned the hard way that ignoring capital protection can be costly. I remember entering trades based on excitement or a strong thesis without fully considering what could go wrong. When markets turned unexpectedly, those positions caused losses that far exceeded my initial expectations. The emotional impact was almost as damaging as the financial loss, leading to impulsive decisions in subsequent trades. That experience taught me that protecting capital isn't just a defensive measure, it's a strategic advantage. It allows you to stay in the game, remain confident, and make rational decisions even when the market becomes volatile. Protecting capital begins with assessing risk objectively. Every position you take should have a clear understanding of potential downside, and you need mechanisms in place to limit exposure. Early in my career, I sometimes thought I could manage trade without predefined limits, believing that my judgment alone was sufficient. I quickly learned that the market doesn't care about intentions. Setting stop losses, determining position size relative to your portfolio, and evaluating the worst-case scenario for every trade became essential tools. They provide a safety net that ensures no single loss can derail your overall strategy or jeopardize your ability to act in the future. Another key aspect of capital protection is avoiding overexposure to any one sector, asset class, or trade. Early in my career, I would sometimes concentrate heavily in an area that seemed promising, only to see correlated losses amplify risk during market downturns. Diversification is not about maximizing short-term gains. It's about ensuring that a single negative event doesn't wipe out months or years of progress. Protecting capital through diversification allows you to remain flexible, respond to changing conditions, and take advantage of opportunities without the fear that one mistake will end your trading journey. Liquidity also plays a role in capital protection. Maintaining accessible resources ensures that you are not forced to sell positions at a loss to cover obligations or respond to unexpected events. Early in my career, being fully invested without liquid reserves left me vulnerable during sudden downturns. By keeping a portion of capital readily deployable, I could avoid panic-driven decisions and preserve the integrity of my portfolio. Protection is not about avoiding the market. It's about creating the capacity to act intelligently when circumstances demand it. Finally, protecting capital is as much about mindset as mechanics. Emotional control, discipline, and patience are critical because even the best risk management tools can fail if decisions are influenced by fear or greed. Early in my career, I sometimes abandoned rules during stressful periods, which undermined my protection strategy. Over time, I learned that confidence in your process, combined with a focus on defense before offense, allows you to participate in market opportunities without exposing yourself to catastrophic loss. Protecting capital ensures that you can survive, recover, and ultimately benefit from the cycles that most traders fear. The most important lessons I will learn throughout my career is that patience and disciplined execution are as crucial as any analysis or strategy, especially before a recession. Early in my career, I often felt the pressure to act quickly, to chase opportunities, or to respond to every market move. I thought that speed and intuition would give me an edge. I quickly realized, though, that impatience and lack of discipline often lead to mistakes that can be far more costly than missing a single opportunity. Markets move in cycles, and even the best ideas can take time to develop. Developing the ability to wait for the right conditions and execute consistently according to a plan became one of the most important advantages I could cultivate. I remember the early days when I would jump into trades based on excitement or fear of missing out. I would see a trend forming and immediately take a position, only to be caught in a short-term reversal that erased gains or created losses. Those experiences taught me that reacting impulsively rarely produces consistent results. Discipline means having a set of criteria for every trade and sticking to them, regardless of market noise or emotion. Patience allows me to wait for the conditions to line up so that when I execute, the probability of success is in my favor. Combining patience with a systematic approach to execution transforms trading from a series of guesses into a calculated, repeatable process. Another aspect of disciplined execution is following your process, even when it is difficult or counterintuitive. Early in my career, I often questioned myself, wondering if I was missing out while others profited from hasty decisions. I realized that the market is full of noise and short-term volatility that can tempt you into action. Discipline allows me to remain focused on the criteria I know work over time, rather than reacting to every headline, rumor, or sudden price movement. It's about executing a plan you've tested and refined, not about chasing excitement or attempting to time every fluctuation perfectly. Patience also helps to manage emotions, which is critical before a recession. Markets become volatile, and fear can cloud judgment. Early in my career, I sometimes let fear drive my decisions, exiting positions prematurely or overreacting to minor market swings. I learned that patience allows me to step back, assess the situation objectively, and act only when my rules and criteria signal a clear opportunity. This disciplined approach reduces the likelihood of emotional mistakes and keeps my long-term strategy intact. It also builds confidence because I know that each decision is grounded in a proven process rather than reactionary behavior. Timing and patience are closely linked to risk management. Even the best strategy cannot guarantee success if executed without discipline. I learned that taking positions that meet all my criteria, even if it requires waiting longer than I prefer, consistently produces better outcomes than chasing trades impulsively. Early in my career, I sometimes overtraded, thinking that more activity would produce more gains, but it often just increased exposure to risk. By exercising patience and executing trades according to a defined plan, I can control risk, protect capital, and position myself for higher probability outcomes. Ultimately, the combination of patience and disciplined execution is what separates long-term success from short-term noise. Early in my career, I underestimated the value of waiting, following a structured process, and sticking to my criteria regardless of temptation. Over time, I realized that consistent, disciplined execution allows me to participate in opportunities with confidence, manage risk effectively, and navigate periods of uncertainty, such as recessions, without being derailed by emotion or impulsive decision-making. It's not about being passive, it's about acting strategically, methodically, and with foresight. Most valuable insights I gained over the years is the importance of understanding exposure to vulnerable assets, especially before a recession. Early in my career, I sometimes overlooked how interconnected different positions in my portfolio were and how quickly certain sectors or asset classes could amplify risk during a downturn. I would invest in what seemed like a strong opportunity without fully appreciating how macroeconomic conditions, market sentiment, or sector-specific vulnerabilities could affect it. That approach taught me the hard way that exposure is not just about the size of a position. It's about understanding what could go wrong where risk is concentrated, and how various elements of your portfolio interact under stress. I learned that even high-quality assets can be vulnerable if they are correlated with sectors that are highly sensitive to economic shifts. Early on, I sometimes held multiple positions that appeared diversified on the surface but were tied together by factors like interest rates, consumer spending, or global trade dynamics. When a downturn arrived, losses in one area quickly spilled over into others, and the impact was far greater than anticipated. That experience emphasized the importance of evaluating not just individual investments, but the systemic relationships between them. Understanding exposure means analyzing the potential ripple effects of economic or market changes on your entire portfolio. Another key lesson is assessing vulnerability relative to broader economic trends. Before a recession, certain industries, sectors, or instruments are inherently more sensitive to changes in consumer confidence, credit availability, or corporate earnings. Early in my career, I sometimes failed to anticipate how these vulnerabilities could magnify losses, assuming that strong fundamentals alone would protect an investment. I learned that knowing which assets are most exposed allows me to make informed adjustments, reducing positions in highly sensitive areas, increasing allocations to more resilient assets, or hedging strategically to manage downside risk. Exposure management is proactive, not reactive. Exposure isn't just about identifying risk, it's also about positioning for opportunity. By understanding where vulnerabilities exist in the market, you can anticipate where fear might drive prices below intrinsic value. Early in my career, I would sometimes avoid areas that seemed risky without considering the potential opportunity created by others' panic. Once I learned to evaluate exposure comprehensively, I could identify areas where temporary dislocations offered favorable entry points. The key is distinguishing between short-term volatility that presents opportunity and structural risk that threatens your portfolio's stability. Managing exposure also requires continual monitoring and adaptation. Markets are dynamic, and what might seem safe today can become risky tomorrow. Early in my career, I would sometimes set positions and forget to reassess them in the context of changing economic or market conditions. I learned that vigilance is essential. By regularly reviewing my portfolio for concentration, sector risk, and correlations, I could adjust positions proactively, reduce vulnerabilities, and maintain flexibility to act on opportunities. Exposure management is an ongoing process that requires both analytical rigor and disciplined attention. Ultimately, understanding exposure to vulnerable assets before a recession is about more than just minimizing losses. It's about creating a portfolio that can withstand shocks, identify opportunities, and allow you to act strategically rather than reactively. Early in my career, failing to assess exposure led to unnecessary losses and stress. Over time, I realized that by understanding where my risks lie, making adjustments, and monitoring conditions continuously, I could navigate downturns with confidence, protect capital, and be ready to take advantage of the very market conditions that cause others to panic. I've learned over decades of investing is that the combination of protection, liquidity, quality, and discipline forms the first strategy before a recession. Early in my career, I often approached markets by focusing on a single aspect, finding the next big opportunity, chasing high returns, or attempting to predict the exact market top or bottom. I quickly discovered that none of these approaches worked consistently when uncertainty increased. It wasn't enough to have one advantage, you needed a system, a framework that accounted for multiple factors simultaneously. That realization fundamentally changed the way I prepared for downturns and allowed me to navigate volatility more effectively than many of my peers. Protection is the foundation of this strategy. Without preserving capital, everything else becomes irrelevant. Early in my career, I sometimes entered trades or investments with little consideration for downside, assuming that a good thesis or favorable trend would carry me through. I learned the hard way that losses can compound quickly, and without safeguard, you can be forced out of positions or the market entirely. Protecting capital doesn't mean avoiding risk altogether. It means understanding it, quantifying it, and taking steps to limit the impact of adverse events. By prioritizing protection first, I could remain in the game long enough to capitalize on opportunities as they arose, even during turbulent periods. Liquidity is the next crucial element. Having accessible resources ensures that you can act decisively when opportunities present themselves. I remember early in my career being fully invested, without cash reserves, and when a promising setup appeared, I couldn't participate. I watched others seize the opportunity while I had no flexibility. Maintaining liquidity allows you to move with confidence, adjust positions strategically, and enter trades without the pressure of forced selling or margin calls. It's not just about having money on hand. It's about freedom of action, which is critical when markets become volatile or unpredictable. Quality is equally important. Assets with strong fundamentals, sustainable cash flows, and resilient business models are far more likely to weather the storm of a recession. Early in my career, I sometimes chased high growth or hyped investments, believing that momentum alone would drive returns. I learned that during downturns, fundamentals matter more than hype. Prioritizing quality allows you to hold positions with confidence, knowing that temporary market declines are less likely to permanently damage your investments. It also provides a foundation for patience, because you can endure volatility without succumbing to fear or making impulsive decisions. Discipline ties all of these elements together. It's one thing to have protection, liquidity, and quality. It's another to apply them consistently. Early in my career, I occasionally deviated from my strategy in moments of excitement or fear, and those deviations often led to losses or missed opportunities. Discipline means following your process, adhering to rules, and executing with patience even when the market tempts you to act impulsively. It's the glue that ensures all the other elements of your pre-recession strategy work together harmoniously rather than being undermined by emotional or reactionary behavior. When these components are combined, protection, liquidity, quality, and discipline, you create a system that allows you to navigate uncertainty while positioning yourself for opportunity. Early in my career, I focused too narrowly on single factors, which left me exposed to risk and volatility. Over time, I realized that the true advantage comes from integrating these elements, creating a comprehensive approach that addresses multiple aspects of risk and potential reward simultaneously. This strategy doesn't rely on perfect timing or predictions. It relies on preparation, resilience, and a disciplined framework that allows you to act strategically in any market environment. Ultimately, the first strategy before recession is about balance. It's about protecting capital while maintaining flexibility, choosing quality assets, and executing with discipline. Early in my career, ignoring any one of these elements led to unnecessary losses or missed opportunities. Over time, I learned that when these components are applied together, you can navigate market downturns with confidence, maintain your ability to act, and position yourself to benefit from the very conditions that challenge most investors.